Hello and welcome to our live session today with Peter. So, what's new in the markets today?
Well, we had the US dollar, which tended to edge just a bit higher against its counterparts, nothing dramatic. I think the market is still trying to navigate through various fundamental issues which are affecting the markets right now, the Fed's intentions, the upcoming employment report for November, US employment report for November, which is on Friday, and more or less it seems like it remains rather undecisive. I would note though the unexpected drop of the Canadian dollar yesterday. Under normal circumstances, given that we had a rise of oil prices, which later on stabilized but still gained. We had also the release of Canada's GDP rate, which accelerated more than expected. We would expect the CAD to strengthen. It didn't. On the contrary, it weakened even substantially against the US dollar. It would be interesting to see how the CAD would be reacting today.
Are worries for China still ongoing?
Actually, yes, we had new protests yesterday. And I would also add that the situation remains uncertain. Definitely the COVID cases, the COVID policy measures, which are in effect in China, are a substantial problem, not only on a social level, but also on an economic level. Businesses are struggling. It was characteristic that the National Bureau of Statistics of China released the PMI figures for November earlier today. And both figures showed a contraction of economic activity, which was more or less beyond market expectations. And that was an issue, especially for the manufacturing sector of China, which is huge. I would say that the release practically was another signal that Chinese factories are still struggling. And the contraction of economic activity is expected to weigh also on the country's GDP rate for Q4.
How about Europe?
Well, we had an interesting development. It was expected that Germany's preliminary HICP rates for November would be slowing down. They did. And the slowdown tended more or less to ease market pressure on the ECB to continue hiking at a fast pace, at an aggressive stance. And I would note also that more or less we had also during today's European session the release of France's preliminary HICP rates for the same month, which remained unchanged at around 7%. And more or less both indicators tended to imply that inflationary pressures in the Eurozone seem to have peaked and are about to ease. And that's a positive. By the way, as we're speaking, Eurozone's preliminary HICP rate must be coming out, and it's also expected to ease. So practically, we may see ECB easing on its hawkish stance and on its tightening, monetary policy tightening intentions. But nevertheless, we expect still in the December meeting that at least the QE will be tightened or will start tightening. And at the same time, we still expect that there will be another rate hike, albeit it may be not as wide as the last one.
And what's on the calendar for today?
Well, we have a number of financial releases. We already had from Turkey the GDP rate. They were for Q3. They slowed down beyond expectations at 3.9%, and that was on a year-on-year level, which was indicative of the negative spiral in which the Turkish economy has entered. That's a big issue. I would also note that we had the final GDP rate of France, that was for Q3. The war more or less confirmed the slowdown from Q2 at 0.2% now year on year, and it seems that there is just anemic growth in the Eurozone, in France at least. And that could weigh on the Eurozone as a whole. We're talking about the second largest economy of the area, and definitely it's going to have a bearing. Other than that, in the American session today, I would make a start with the US ADP national employment figure. It's expected to drop, and if actually so, could weaken the US dollar, as it would imply practically that there may be a drop also in the NFP figure on Friday. We don't relate the two indicators. Markets usually do though, and it's worth mentioning. The highlight of the day is expected to be the US GDP rate. It's a second estimate. It's for Q3 on an annualized basis, and it's expected to more or less accelerate slightly, actually to tick up to 2.7%. It would be a positive, and it would reaffirm more or less the growth for the US economy for Q3, and could provide some support for the US dollar. I would also be noting for oil traders the release of the EIA weekly crude oil inventories figure. We had yesterday the AP crude oil inventories figure, which showed a substantial drawdown of oil inventories in the US, more or less implying that production levels were not able to catch up with demand. And thus we have a rather tight oil market in the US, which could provide further support in oil's prices, should that be verified also today by EIA. During tomorrow's Asian session, I would be noting two releases. The first would be from Australia, the capex growth rate. And should there be an acceleration as expected, we may see some support for the Aussies. That would imply practically that Australian businesses were confident enough to actually invest in the Australian economy. And the second would be from China. That would be the Caixin manufacturing PMI figure. It's for November. Should the wide contraction, which was practically reported by the NBS manufacturing PMI figure for November, be verified, that would be another signal that practically Chinese factories are struggling.
And what's up on a monetary level?
On a monetary level, definitely Jerome Powell's speech today is standing apart, could be a market mover. Now, the Fed chairman is going to be speaking about the economic outlook in the US and what the prospects are. Now, should he sound rather confident that the US may be able to avoid a recession, possibly highlighting also a rather tight US employment market, and on the flip side that inflationary pressures are still high, that would imply a more hawkish approach to monetary policy and could provide some support for the US dollar. Other than that, I would also be noting that we have, during tomorrow's Asian session, two BOJ policymakers, among which I would be highlighting BOJ Governor Kuroda. Mr. Kuroda most probably will be keeping a more reserved stance, stressing the supportive role of the bank for the Japanese economy, and most probably will be tilting towards the dovish side. An exit or a strategy from an exit from the bank's ultra loose dovish policy for the time being is not expected. However, it's being widely discussed, and at some point I think BOJ will have to address that issue.
Any final comments for today?
It's going to be interesting to see whether the GDP rate of the US as well as Fed Chairman Powell's speech is going to be increasing volatility somewhat. We had rather low volatility yesterday. Once again, it's like the market is slowly but steadily preparing also for the release of the US employment report on Friday. Nevertheless, should the Fed chairman actually get out of the script and actually provide new clues, that could shake up the markets.
Thank you, Peter. Stay tuned for our next live session with Peter.
Welcome to the technical analysis part of the presentation for today. Now, in front of your screens, you have the USD index for our chart. All charts to be presented are to be of the same time frame unless otherwise stated. Now, there were some slight bullish tendencies for the US dollar yesterday, and there seems to be a rise, but nothing dramatic. You can see that the price action practically remained between the 105.55 and the 107.15 levels. So more or less, despite the slight upward movement of the US dollar index, we tend to maintain our bias for a sideways motion for now. It's characteristic that the RSI indicator below the 4-hour chart is currently at the reading of 50, implying a rather indecisive market. And in this case, I think that the technicals reflect the fundamentals. The market on a fundamental level is more or less trying to navigate between the various fundamental issues which are floated today. I would be noting, say, for example, the unrest in China and the Fed's intentions about its monetary policy, Powell's speech. I think the market is preparing more for the release of the US employment report for November on Friday. Once again, a sideways motion seems to be appropriate here or expected. Nevertheless, we may see Fed Chairman Powell's speech and the release of the US GDP rate for quarter 2 altering US dollar index's direction. Should the bulls take over, I would expect the price action to rise, break the 107.15, and start aiming for the 109.10. On the flip side, should the selling interest be expressed by the market for the dollar, we may see the dollar dropping, breaking the 105.55, and start actively aiming for the 203.50. Let's have a look at the Euro USD, also in a sideways motion. Now, Euro USD, the big question here is whether to readjust it or not. It broke it shortly, and we have to note that at this level you can see that there was a lower here, but could be a little bit higher at 1.0325. The 20 pips correction. And let's readjust the chart. You can see that practically the sideways movement seems to continue. It has shifted, the price action has shifted the lower boundary a little bit more to the south, 20 pips lower. So we tend to maintain our bias for sideways motion to be still present, most probably between the S1 and the R1. On the other hand, more likely it is that it remains closer to the S1 rather than the R1. I would be noting here that the RSI indicator is also near the reading of 50, implying once again a rather indecisive market. It's characteristic how USD driven the pair is, despite a number of financial releases coming out and which were of high importance. Say, for example, we had the release of Germany's HICP, preliminary HICP rates for November yesterday, which showed a slowdown, and the euro didn't move. And we had also the release of Eurozone's HICP rate that was today. And the CPI rate, the HICP rate, slowed down even more than expected. It reached from 10.6, it dropped to 10. And that was another indication that practically inflationary pressures in the Eurozone seem to have peaked and are about to slow down. I would like to show you here the release, the market reaction at the time of the release, drilling now to the 1 hour chart. Sorry, the 1 minute chart. It was at 12 o'clock, just about now. 12:07. It is. You can see how Euro USD barely edged higher. It actually rose a little bit. But that was in the following 15 minutes. So at the moment of the release, there was only a 6 pips movement, nothing. So once again, we highlight here that for Euro USD, the US dollar is the currency which maintains the initiative over the direction of the pair and remains sideways. Now, should the bulls show their face, we may see the pair rising, breaking the 1.0485 and start aiming for the 1.0605. On the flip side, should the bears take over, we may see the price action dropping, breaking the 1.0325 and start aiming for the 1.0220. Once again, main base scenario, if you prefer, is for the pair to remain in sideways motion, given also that the RSI indicator remains near the reading of 50. Let's have a look at cable. A similar movement. Let's correct the labels a little bit here so we get a clearer picture. Cable was also locked in a range-bound movement, a rather tight range-bound movement, just above the 1.1940. For the time being, we maintain our bias for a sideways motion to continue, just above the S1. It's also very characteristic how the price action, or if you prefer, the lack of volatility, has narrowed also the Bollinger Bands. See how they have converged. Now, let's shoot the best take over. I would expect the price action to break below the 1.1940, which was beautifully reaffirmed yesterday in the late American session, and aim for the 1.1705, a level which provided some support back here with a double drop. It was more evident in the 1 hour chart. On the flip side, should the bulls take over, say for example, should the US dollar start weakening, we may see the pair rising, breaking the 1.2150, which was a peak, and start aiming for the 1.24 resistance level. Let's have a look now at USD and JPY. also in sideways motion, with the difference here that the sideways motion, as we have mentioned it yesterday, it was characterized by a number of elements. The first would be the breaking of the downward trend line guiding the pair. The second would be the narrowing of the Bollinger Bands. And the third would be that the RSI indicator rose slightly, reaching the reading of 50, implying rather indecisive market at the moment. Now, we maintain our bias for a sideways motion to continue between the 139.65 resistance line and the 137.50 resistance support level. Now, should a selling interest be maintained or be expressed, if you prefer, by the market, I wouldn't be surprised to see the price action dropping, breaking the 137.50, which provided support here, and start aiming for the 135.80. On the flip side, should the pair find fresh, extensive buying orders along its path, we may see the price action rising, breaking the 139.65, and start aiming for the 142.15, a level which provided support right here, and that was on the 21st of the month. Moving now to USD CHF. Now, this is an interesting move in the sense that the pair had an upward motion, yet it was broken during today's European session. It was very characteristic, and in our opinion, for the time being, given that the price action failed to actually break below the 0.9495 support line, it was a false break here, but nevertheless, it's still above it. There's a good chance that the pair may start stabilizing, and that's an issue. So we switch our upward trend line. We have highlighted yesterday how fresh the upward trend line was and how volatile it was. And it was broken after 24 hours. Once again, we tend to maintain a bias for a sideways motion now, and that would be probably just above the 0.9495 S1 support line. Mind you, the RSI indicator has dropped and it's just above the reading of 50 for now. So that's another indication that probably the sideways movement would be maintained. Now, for us to change our bias for sideways motion in the next 24 hours in favor of a bearish outlook, we would require clear breaking of the S1 0.9495 support line and the price action to reach as low as 0.9395 S2 support level, a level which provided support here. On the other hand, we may see the bulls regaining control over the pair's direction, rising, breaking the 0.96. We would require a higher peak than this one, and start aiming for 0.9735. Despite the low volatility, USD CHF has proven in the past, you can see this movement here, how volatile it is, or this movement, that it could reverse very easily and should be taken care of when trading. Let's have a look now at commodity currency pair AUD-USD. In a similar fashion, in a sideways, clear-cut sideways motion between the 0.6640, which was practically reaffirmed yesterday. That was on the 28th. Yep. And we expect the sideways motion to continue. It's probably between the 0.6795 and the 0.6640, so it could be a little bit wide, but that's understandable for a commodity currency pair, and remain in this spectrum. We're talking about a distance of around 155 pips, pretty wide. And for the time being, I wouldn't expect anything else. For a bullish outlook, I would require the pair to rise, break the 0.6795, and start aiming for 0.6915. On the other hand, should the bears take over, we may see the price action dropping, breaking the 0.6640, and start aiming for the 0.6545. The RSI indicator rose slightly, has broken above the reading of 50. It's actually right now at 56 almost. So there may be some slight bullish tendencies, but in my opinion, they're still too weak to actually provide substantial support for the pair. Let's have a look also at the surprise of the day yesterday. That would be USD CAD. Now USD CAD, if we drill out to the daily chart, it would be more clear. We had a wide rise for a third consecutive day, full of volatility, and it's correcting lower today. And I'm saying the surprise of the day because USD CAD was not expected to rise. USD CAD, based on the fundamentals, was expected to drop. We had a rise in the stabilization of oil prices, which should, under normal circumstances, support the Canadian dollar. We also had the release of Canada's GDP rate for Q3, which was substantially better than expected, which should also support the Canadian dollar. Both actually failed to provide some support, and USD CAD was allowed to rise further. Now, the big question is, do we see a continuation of the upward trend line? An interesting idea was set by a colleague at the research department, highlighting that we should be shifting actually the upward trend line to the right, and that for the time being, yes, there's still an upward trend line. Let's drill out. I think this makes it more clear. In my opinion, that could be the case. However, before we move on, let's make the readjustments of the resistance and the support lines. The R1 has been broken. And given that the price action is above it, it has to be turned into a support line. Let's go hunting for a new resistance line, ultimate resistance line, and that would be up here at this peak here. It was also verified here, so I think it's a pretty valid level. It's corrected in red, and that would be the 1.3810. Lock this in, readjusting the charts. Let's correct also the labels. Making a start with the S3, which is being now at 1.3230. Second resistance line, support line being placed at 1.3320. First support line being placed at 1.3470. Let's check out also the resistance lines. I'm going to be holding the one, despite the clear breaking yesterday of it, as it still has this touch here and this touch here, and that, in my opinion, keeps its validity intact. 1.3570, 1.3685, the second one, and the final support or resistance line being placed at 1.3810. Locking everything in. Now we discussed how the price action corrected lower during today's European session. However, for the time being, we still consider this to be of temporary nature. It's a mere correction in our opinion. And such a notion or such an idea is being also supported by the RSI indicator, which remains clearly above the reading of 50. It's actually right now at 62, which implies that there's still a bullish sentiment left in the market for the pair. Should the bulls maintain control, we may see the price action rising, breaking the 1.3570 and start aiming for the 1.3685. Now, it may be seemingly being a little bit far-fetched. In our opinion, not. USD CAD could easily cover the distance and then some, given that you can see the price action of, let's have a look, of 232 pips, almost 240 pips, and that was covered within 12 hours. So should the pair rise a similar 200 pips upwards, that would land it from 1.35 to 1.37, somewhere here. But for the time being, we keep our R2, especially given that we had a beautiful reversal of an upward motion. It was a beautiful V-shaped reversal. And that was practically at the end of October, beginning of November. Nevertheless, should the stabilization occur, given the correction lower, the first signal, in our opinion, would be a breaking of the upward trend line. Yet at the same time, I would expect the price action to respect both the R1, 1.3570, and the S1, 1.3470. And that would bring it practically in this space here. On the other hand, for a bearish outlook, we would require a clear breaking of the pre-mentioned upward trend line. That's definitely one. The second would be also a requirement. That would be a breaking of the S1, 1.3470, and the price action to start aiming for lower grounds, possibly the 1.3320, which provided support here and tested to the upside here as well. Okay, let's have a look at the Kiwi. We haven't looked at it for a while now. The Kiwi is in a sideways motion, yet we have to make some readjustments here. Definitely this show here has to be represented. Okay, let's make that. One resistance line is here. One support line is here. See how we have a double touch here. And the next one, I will be placing it somewhere here. Let's go now for resistance lines. Unlocking the chart. I'm choosing this peak here. I know it's pretty close to the price action. It could be a little bit wider. But this level was tested once, twice, 3 times, 4 times. Seems to be pretty valid. I'm keeping it. Also, I'm keeping the R3. Okay, let's readjust. This could be narrower. See the touch here, or the testing here. Okay, let's keep the levels narrow. And we make a start with the R3 at 0.6460. Second resistance line would be placed at 0.6380. First support line, let's have a look, at 0.6290. First support line now being placed at 0.6155. Second support line being placed at 0.6060. And final support line being placed at 0.5980. Now this was a quick, very, very quick calibration of the chart. In order to be able to reflect the new troughs and peaks. It is. And the DUSD, for the time being, we maintain a bias for a sideways motion to continue, probably between the 0.6290 and the 0.6155 levels, the R1 and the S1. The RSI indicator below our 4-hour chart has moved a little bit higher than the reading of 15, implying some slight bullish tendencies here, but they're too slight. They're only at 56.5. So they're still not convincing for a bullish outlook. Note how the Bollinger Bands have converged, implying or reflecting, if you prefer, the low volatility of the pair. I would be also noting that we have higher peaks, higher troughs, but for the time being, nothing conclusive yet. For a bullish outlook, we would require clear breaking of the R1. I would require a higher peak than this one, and the price action to start aiming for 0.6380. On the flip side, should the bears take over, we may see the price action reversing direction, breaking the 0.6155, and start aiming for 0.6060. And another chart which I would like to have a look at would be oil. We had a look at it yesterday. Okay. It's an interesting chart. It's an interesting chart practically on two elements. The first is that the pair has broken both the upward motion, which it had initiated practically on Monday. Let's have a look. Yep, that would be on Monday the 28th. And seems to have stabilized. However, we have a rise during today's European session above $79. I will be keeping the 79 as a support line. And I will be keeping also the 75.40 as the second support line. And the 72.55 as the third one. Let's have a look at that last one once again, just to verify where it stands, where it's based at. Yep, pretty valid. It has also some touches to the upside. Seems good. So the support lines seem to remain valid. Also note how it was validated here for the S1. Some commotion. And the commodity's price action escapes practically the narrow range bound movement it had present in the late American and early European session today. In the late American and Asian session today. What I would like to have a look though is the market reaction at the release of the AP weekly crude oil inventories figure. It was a substantial drawdown of over 7 million barrels. It was yesterday at 11:30. Let's have a look. Yeah, it was a drawdown of minus 7,850. 11:30. We're still at 2 o'clock, 11, 11:30, 34, 35, 32, 31, 29. So there was a rise. Not a substantial one, but still present. Okay. Back to the 4-hour chart. Looking for direction. For the time being, we maintain a bias for the price action to remain in a sideways motion. Yet I would be noting the rise of oil's price of WTI's price during today's European session. The levels seem to be valid, but anything less than reaching the 83.50 for me, it's still a sideways motion. So that should be it for the day. From all of us here at IronFX,
Today, we will look at debt-based investments and their difference from stocks. While as a trader, you can trade stocks via CFDs without actually owning the underlying instrument, an investor will invest in the actual stock and own it. Most investors focus on investments that aim to increase wealth and to help them reach their financial goals like a comfortable retirement or the ability to pay for their children's education. When investors buy stocks, they purchase assets whose value is expected to increase and provide a nice return when sold. Investing in stocks also allows the owner to access a portion of the company's profits through dividends, share buybacks, or reinvestment, which helps to grow the company's and the stock's value. The stock market offers volatile returns over short periods of time, such as 5 years or less, but high returns over decades, long time periods. Debt investment can be government, corporate, and municipal bonds, as well as real estate investments, peer-to-peer lending, and personal loans such as mortgages. With a debt-based investment, you do not own an asset or a company, but instead you lend money to an individual, corporation, or government in exchange for a fixed income in return. Such investments typically offer a lower return than stocks, but are considered to be more consistent. There is some risk involved, as you might not be able to receive the funds you have loaned, and it's so important to choose your investments wisely. While they might be less risky and volatile than equity investments, they offer lower returns. The bond and mortgage market has fewer price changes than stocks. Equity investments, such as stocks, are securities that allow investors to have a claim on the earnings and assets of the corporation. Common stock trader on popular stock exchanges is the most popular equity investment. The stock market is very volatile, with rapid changes in share values. These fluctuations are usually related to political, social, or other issues in the home country of the corporation. Equity investments are famous for high risks and potentially higher rewards. It is traditionally recommended to investors that they hold both equities and debt-based investment for better diversification of their portfolio. Debt-based investments perform differently than stocks and increase during years of large stock declines. An individual's exact allocation is dependent on the investor goals, risk preferences, and investment time horizon. When it comes to trading, it is important to understand that all trading comes with risk. Depending on your trading goals, you can choose what suits you the best. You can always tailor your trading actions to match your objectives and risk tolerance. Thank you for watching.
Good evening, guys. Welcome to another session of IronFX. Hi, Gideon. Hi, Samuel. Nice to see you guys. Hi, Kurt. Hi, Kurt again. Welcome back. So I'm Annabelle. I will be your host for today's session. Hi, Kurt. I will be imparting some of the Fibonacci extension skills to you guys. This is only my second webinar, so please bear with me. Keep those questions and posts coming in on the chat. I will reply as accurately as possible. Hi, Aisha. So how are you guys on a Wednesday? It's TGIW midweek. So I'm here 6 p.m. Singapore time, while everyone else is just chilling, having a glass of wine or beer, relaxing. Let me know what you're up to. Hi, Kingsley. Let us give the rest of the participants some time to come in before I start the session. 11 a.m. here. Oh, where are you from? Yeah, let me adjust the table. Oh, England. Hi. Oh, I've been there. I used to study in England. Hi, Walu. Hi, Adeyemo, if I pronounce your name correctly. Oh, thank you. Nigeria, I see. Hi, hi. Hi, Kingsley. So maybe 2 more minutes. Keep the questions coming. I will try to reply if I have the time. Today we'll be going through extensions. I will do a quick recap on Fibonacci retracement because we have done that the previous session. I'll do a quick recap before we start the next session on extensions. Hi, Kingsley. Oh, from Nigeria. Nice to see you. Sorry, I think I got cut off. Okay. Let me know if you can hear and see me. So if at any point in time you can't see or can't hear me, do let me know. Let me adjust. Sorry. It is better. This might be better. Okay, maybe we can start the session. So this webinar series is brought to you by IronFX. We are talking about the second part of the fourth Fibonacci extension. So just a risk warning. The information in this webinar should not be construed as investment advice or an investment recommendation, but educational material only. So this should not be construed as investment advice. Please practice your due diligence. Let me adjust, sorry. You can see my face. Okay, there are 2 Samuels. Hi, both. Okay. So the agenda for today will be quite long. We have the ideal market structure, following the trend, these are all important and fundamental skills that we should be touching on and recapping a lot of this for your retracements and analysis tool, because these are the basics that you need to master before you can do your extension, expansion, and projection. So following the trend line, the different retracement levels, your Fibonacci extensions, Fib levels above 100%, which is your extensions, some practices, and then I will talk to you guys a bit about the combining of Fib retracements, meaning we'll put together all the different retracement tools to make your trade more accurate. So let me know if you guys have used the retracement tool before, Fibonacci, either the extension, the expansion, or the projection. So let me know how professional or maybe if you guys haven't heard of this tool before, do let me know in the comment section. Gideon, I haven't. Yeah, so that's why this will be a beginner's educational video. I'll try to be as slow as possible to explaining all the different terms or the different levels to you. I'll make it as simple as possible. Okay, Joel, I've used it and it's awesome, but I still need to, okay, yeah, yes, this will be a good session to recap and to learn. Okay, so maybe let me give you a quick reason why people actually use Fibonacci retracement. It's actually a very powerful tool if you can get it correct. It helps you to draw support lines to identify your resistance, support levels, or where you can actually place your entry, stop loss, take profit. So this tool is extremely important and you have to get it right, because if you actually plot on the wrong points or the wrong levels, then it won't be useful. Okay. So this will be the team that will take you through all the webinars going forward. Sorry, my picture is not there, but introducing the team. These are all my colleagues in, okay, yeah, these are all my colleagues in Everest Fortune Group. If you have any, okay, maybe I'll do a brief introduction. So this is Desmond Leong, our chief trader for Everest Fortune. We have Cassandra Ng, a prop trader, Melanie, investment analyst, Jianing, and Joanne. So sometimes aside me or Desmond, you will see the rest of the team hosting some of the webinars. So if you have any questions throughout the webinar, I encourage you to send them through this chat. As I have another screen that is open so I can monitor the questions. So it's better for you guys to ask when we are analyzing or when we are going through all the slides, so I don't need to jump back and forth on the different setups. So this webinar is brought to you by Everest Fortune Group in collaboration with IronFX. We are an award-winning research firm and finalists in 2019, 2020, 2021, and the best finalist for equity research in 2020, 2021. So what we do is we work with the major financial institution to help them forecast where the markets are actually going and also help them host educational webinars like this. And now we have a special partnership with IronFX where we bring you guys the good stuff every day. Okay, so let's start the session on extension. Cool. So before that, we need to go through the fundamentals, the most important thing, because you need to know how to draw your basic retracement levels before you can actually go to the extensions. So the ideal market structure. So what I mean by ideal market structure is that you always have to look for significant swings. So these are very insignificant swings that we are looking at. Ideally, for retracement Fibonacci tool, we look at the H1 or H4 charts. So we don't usually dwell into the 15 minutes or even the 5-minute charts, because as you can see here, hi Odofin, hi. As you can see here, if you zoom into the lower time frames, sorry, Sorry, guys. Bear with me. Okay, so if you can see, these are very choppy and very inefficient candlesticks. So it's not effective and not accurate in providing your trends or your ideal market structure. So we want to look for significant swings like this, big movements, not the choppy ones, because they will make your levels very messy and inaccurate to read. So we are looking for significant swings like this. Later, I will go to a live chart and then I will show you guys what are significant and insignificant swings. Okay, following the trend. So before you actually look for your Fibonacci levels, you need to know where the general market or the market sentiment is going. So you need to follow the trend correctly. And you also need to draw your trend lines correctly before you can do that. So if the market is going in a bullish trend like this, then we'll be looking for extensions. Okay, so the rule for Fibonacci, if you guys have tuned in last week, do you remember what are the rule of thumb? What is the rule of thumb? I think there are two rules that I highlighted last session with you guys that is very, very important. This is a hint. So you can see that the Fibonacci trend line cuts through the price structure. I can give you guys a hint. Let me know. Okay, I have some answer. Yeah, can cut through. Okay, so what we mean by follow the market structure means that when you draw a Fibonacci, you have to draw the trend line closer, as close as possible to your price structure. So in this sense, it's not very clean because you see here, there are a lot of gaps. Okay, maybe I can show you guys. Maybe I can show you guys. So meaning if you were to draw a trend line or a Fib retracement, this would be very accurate. Sorry, let me remove drawings. This would be an ideal Fibonacci retracement level or trend line. Whereas, let me know in the comment section, do you think this is a good Fibonacci retracement level, trend line? Any idea, guys? Okay, this is not an accurate trend line because, yeah, it's not good. Yes. Yeah, this is not good because you can see that there's a lot of space here. So this is inaccurate. For trend lines, Fibonacci trend lines, it's best to draw as close as possible to your prices. It shouldn't deviate too far like this. So this is good because all your prices are very, very close to your trend line. So this is a very accurate Fibonacci retracement level. Okay, so the rule of thumb, like I've mentioned, let me go back to my slides. Okay. So the rule of thumb is that the trend line must follow the price structure clearly instead of cutting across and the price deviate too much. So firstly, you need to understand how to draw the trend line accurately. So this is a very important fundamental skills. You need to draw it correctly before you can learn extension. Okay, yeah, this is a very accurate line, as you can see. So just to highlight, for Fibonacci retracement, it's not just sorry, okay. So for Fibonacci retracement levels, it's not just a one-way direction, meaning it can be from bottom to top or top to bottom, depending on where the market is moving. So it's dependable on where the market is going. It can be from the bottom here, the swing low to the swing high, or it can be from the swing high to the swing low, depending on where the market is moving. So a Fibonacci retracement tool is used to gauge where your next reversal might be. So it helps you to better gauge whether you should take a entry at this level or take profit or put your stop loss. So these are levels to help you identify your support resistance. Okay, different fit retracement levels. So anyone knows what are the different, anyone in the chat knows what are the different Fibonacci retracement levels? Okay, let me show you guys. So the reason why we actually use all the different percentages of the Fibonacci retracement is because all these different tools will help you, when combined, will help you make a successful trade, make your trade more successful. So the range for a Fibonacci retracement can be beyond or below 0 or 100%. So for example, in this chart here, you can see that the range of Fibonacci retracement is from 0 to 100. This is your retracement level. Once it actually breaks above the 100%, we call this the extension. So this is what we are going to learn today. Fibs that are above 100%, they are called the extension, Fibonacci extension. So what if it doesn't break above the 100, but it goes below to the negative range? So you can see here, minus 27.2 and minus 61.8. These are negative Fibonacci retracement, which is called the expansion. So these three tools combined will actually help you identify a more and strong support or resistance level, which you can then place your trade. Okay, so Fib levels below 100%. Yeah, this is what we're going to learn today. Note that once your Fib level goes beyond the 0 to, let me just go back. Note that retracement level only works if it's within the 0 to 100 range. Once it breaks the 0 to 100 range, it's invalid. So let me show you what I mean by that. Okay, let's see here. Okay, let me draw a Fibonacci retracement here. Okay, so for example, for Fibonacci retracement, once you draw the trend line, okay, this might not be the greatest. Okay, let's do this. So once the level has broken 0 to 100, right? You guys can see all the different Fib levels, 0 to 100. Once the Fib level actually breaks, see, it kind of breaks here. And it broke the 23.6, broke here. So now it's coming to test at this level, at the 50%. So this is 50% will be the only one that's valid. So we can take away all this. Those that are broken are invalid. Please take note. Okay, so Fib below 100%, they are called the expansion, which we will learn in the next session. And then there is Fibs that are above 100%. They are called the extension. So this will be what we are learning today. And the important key levels to take note will be 127 and 161. So let us dive into it. I will give you guys some tips as I go along and analyze the charts, right? Okay, let me know hi. Okay, so let me know if you guys have any questions along the way. Just post in the chat and I'll reply. Yeah. Okay, so maybe I start with this chart here. Hit levels above 100%. So starting point will be here. You can see the starting point. So the number one tip that I will give you when you are using Fibonacci extension, remember it's extension, not expansion. So extension, the tip will be to find the Nike tick. So you can see here, we are always looking for a Nike tick. It can be either this way or an inverted one. So it's not necessarily always a V. It can be an inverted V as well. Sorry, excuse me. So it can be this way, or it could be, let me find one, or it could be this, maybe this way. Okay, so it can be here or here, depending on which price or which levels you are looking at. Yeah. So we are always constantly looking. Oh my God, I'm so sorry. Okay. So let me go to live examples to show you guys how Fibonacci extension actually works. Let's see. Okay. If you have any requests for any currency pairs, do let me know in the chat as well. I can do a live analysis to show you guys using the retracement tools. So maybe let's start with USD. GBP. Okay. Okay, I'll go to that shortly. XAU. Okay, I have some requests. Gold USD, GBP, JPY, GBP, USD. Yes, I will go to that. But maybe I will start with USD, Swiss franc. Yeah. Okay. So for this chart, can you guys identify where is the Nike tick? Is it from, can it be from here to here? And then maybe I don't use the levels yet. I'll use drawings. Can it be from here to here? Is this an inverse Nike tick? Or can it be from maybe this could be one. This could potentially be one, but it didn't break out of the note. Remember what I thought? What I taught you guys, it has to be above the 100%. So if your retracement is at the 100%, it's not within the extension zone. Sorry, it's not within the extension zone, which is above 100. So we don't consider this as the Nike tick. Yeah. Okay. We could use. Let me find a good example for you guys. Yeah. Just bear with me. So remember also that we are looking for significant. Okay, maybe this could be a good setup. Significant swing low, swing high. So this is quite significant. Let's see whether this is what 4 hour. Can zoom in. Sorry, guys. Remember, you're always looking for significant swings, yeah. Let me see whether this works. Okay, yeah, here. Okay, this is quite a good setup. Maybe let me Okay, let's try this. Okay, so now the trend is actually, remember the rule of thumb and what you should be looking for. So always remember you should go with the trend line. So it's now going on a bearish trend. So it's very strong in its descending channel, in descending trend. So let's see. Okay, what I will do usually when you are looking for a setup for the extension is that it has to create a V, because we are looking for the Nike tick. So always look for the V. And tip number 2 is that it has to break the 100% retracement. Remember? Because if it's still within the 0 to 100 range, it is not considered as an extension. So at this point in time, this level here, when it breaks, it has my attention for this setup. So I will wait for prices to actually reach the 127 or the 138 before I take my entry for a short, because the Fibonacci extension tool or the Fibonacci retracement in general is used for reversals, to spot for reversal setups. So at the key level for extension would be 127 and 138. These are the two that I will highlight. I mean, not all setups works, but you could actually potentially make quite good gains if you can spot the Nike tick. So you move forward. Okay, 127, right? Okay, this is actually where I would take my trade, or maybe slightly higher. So if you want a very accurate indication whether you should take this trade, you should actually look for other tools that can be in line and confirm this trade. For example, okay, it's a bit messy. Okay, never mind. We'll just do this first. Let me show you the example of how the reversal works first. So once it touches the 127, it tends to reverse in the opposite direction. As you can see here, it touches exactly here. And then at the 100% would be the usual spot that I take my profit. So here, entry, and here take profit. Stop loss, give and take, you should, depending on your risk appetite. Yeah, yes, I'm getting to that, Gideon. So your stop loss would be at the 138.2 level, or maybe slightly above, because you need some space, some buffer zone. Sometimes it will go a bit further. And also depending on what's your risk appetite, you could be a ratio of, it could be in a ratio of 1 to 3. So it's all depending on your risk appetite. But usually I would place my entry here, my stop loss at 138 or 141, depending on what risk level you are at. And then take profit is usually at the 100%. And depending on all other indication using the other tools like your expansion, projection, your support levels, key levels, all that, you can adjust accordingly. Yeah. Okay. Okay, so this is a live, that was a good example on the Fibonacci extension. So maybe now I can go on to ICG. Okay, let's try GBP. Okay. Okay, GBP USD. Let's see. Okay, now we have to look for the Nike tick. Actually, this could potentially catch my attention because remember the tip that I gave you guys? Always look for the V and Okay, I will draw here. Okay, so now it's almost touching the 100% Fibonacci retracement level. So once it actually breaks this level here, it will have my attention because it's quite bullish in this sense. It's quite bullish. So I'm thinking it might be going up to test at the 127 level since the overall might be a bearish trend. So okay, let's use the Fibonacci retracement to see whether there are other indications that confirm this trade. Give me a sec, yeah. Okay. 78.6. Okay, this is quite a good level. So you can see here, let me just adjust the chart. It's slightly messy. I want you guys to see. Okay. So at this level here, you can see that, okay, this is the 127.2% extension level from this V that I have charted. This is also a key major overlap support or resistance. I will highlight this. Okay. So it coincides together. And then it's also a 78.6% retracement level from here, my top to my bottom. So potentially it will be a very good setup if the price can break this 100% retracement level. So what I'm thinking is prices might go up, break this level. My entry will be here for a short. And let me just, maybe I can type up. Okay, here will be my entry level for a short position. My take profit would be somewhere here. At this level, take profit. Sorry, this is my stop loss. My take profit will be somewhere below. Take profit will be here, sorry guys, at the 100% or slightly above, depending on your risk appetite, like I've mentioned. Yeah. So for retracements, actually, you can't rely on using it alone. So you have to use it together with your other tools like your support resistance, maybe your Ichimoku or your expansion projections. It can't work on its own. So please take note. So for GBP USD, my analysis would be if it breaks this 100% level, it will go up to test at the 127.2, which coincides with the key support resistance level, overlapping support resistance, you can see here, as well as a 78.6 retracement level. So there are three tools that I've used here to confirm my trade if it actually passes this mark 100 level, 100%. Okay. So any questions? Hi Samuel. Which broker am I using? Okay, I'll get to that later. While you NL, what do you mean by NL? My Adi, sorry, yeah. Adiomo asks, can you give us your setup? What do you mean by give you my bit setup? I don't quite understand. Okay, let us try. Let me go to the next one. Here we try go, yeah. Let's do an analysis on go. Okay. Can you guys identify where is the Nike tick? How to set up? How to set that on TradingView? Oh, Adiyamo, you mean for which pair? Which pairs are you referring to? Let me know in the comment while I do the goal analysis, yeah? Okay, so let's look for some examples. Okay, let's try this. Okay, I think this would be quite nice. Okay, let's zoom in. All right. Okay, so for example, let me chop off here. Okay, things to take note when you draw your. I will get to that, Joel. We still have plenty of time, yeah. Okay, so for this gold USD setup, let me show you another one. Okay, when you draw your Fibonacci extension, okay, all fibs. Okay, Nike tick, remember, always remember that your Nike tick can be in this manner or in an inverted. So don't always aim for a tick that is this way. You can also do the opposite this way. Yeah. So one mistake or one tip that I can give you is that when I mean inverse, it doesn't mean this way. This is wrong. Yeah. Let me pin the chart. So this setup here, okay, remember, always look for the V. Okay, so once, shoot. I'm so sorry, guys. Bear with me. Where is my setup? Okay, let's try this. Okay, let me show you an example again. Okay, remember my tip, always look for the V, yeah? Okay, as you can see here, once my price is very close to my 100%, it will get my attention to look out for the Nike tick. Okay, so once it touches, okay, this is quite fast. I need to, okay, for example, okay, so once it actually touches my 100%, you can create a pending order as well. So once it, or a notification or alert. So once it hit my 100%, it will take my attention when I will actually zoom in on this analysis or to take an order, take a position, or put a pending position. So once it touches my 100%, you should actually zoom into it. So from here, like I've mentioned, you can't always only use one tool, like the Fibonacci extension. You need other tools for confirmation. So let's zoom out. Okay, maybe you can do a retracement level, for example. Okay, this is very messy. Sorry. Let me clean it up a little bit. 127. Okay, so here, so the other tools, you have to zoom out to see whether there are any other support or resistance level or overlapping support resistance. So for example here, okay, that's quite far. Okay, actually this would be a key highlighted levels. Okay, actually I will draw this. Let's try. Okay, that's not that great. That's not that great. As an example. Okay, never mind. Okay, we'll just move forward with this. I'll focus more on the extension. So once it breaks the 100% level, I will take note to see if it actually goes to, oh, so this will be the level. So at this level, you can actually place it slightly above the 127 because not all the time it will hit exactly the 127.2 extension levels. So your order could be slightly above here. It could be slightly above, maybe here. And then your take profit would be, my take profit is always at 100% level. And then your stop loss might be at the 138.2 or slightly further, depending on what's your ratio or what's your risk appetite. Okay, so to reiterate, whenever you are looking for an extension setup, look for the V. It's very important. Always look for this V or a Nike tick. It can be inverted, it can be this way, but always look out for the V, and it always have to break the 100% level before you actually zoom in. Okay, Joel asks, what's the name of this fig you're using to get 127? Okay, the tool that I'm using is called Fibonacci retracement. All these levels, okay, maybe I do a recap again. So all this expansion, they are actually Fibonacci, we actually use the Fibonacci retracement tool. It's just the levels that are different. So for example, okay, let me do this. Okay, if you guys can see, okay, like I've mentioned in my slides just now, levels between 0 to 100, this level is called the retracement, Fibonacci retracement, because it helps you understand where, at which point in time or at which percentage the prices might reverse. So Fibonacci retracement tool, it's to let you know where it might reverse. It's a reversal tool. So for example, let's say here, it's testing at the 23.6%. So once it breaks, this is invalid. And then it comes here to test at the 61.8%. So once it breaks, this is invalid. So for a Fibonacci retracement tool to work, it has to be below, for example. Okay. Oh, this is not right. For example, here. Okay, let's use this example, yeah. Okay, you just focus on, okay, let's focus on this area here. Okay, so ignore this part. Oh, shoot. Okay, so for Fibonacci retracement, 0 to 100 level, okay, it's currently testing this level. So it hasn't break the 38.2 level. So this is still valid. The 23.6% level is actually broken, so you can remove it. So technically, for this retracement tool, only 38 and below like 38, 50, 61, and 78. Only those below here will be valid. Those that has been cut off or retraced already is not valid. So the only valid level is the 38.2%. So this is the typical Fibonacci retracement. So for the rest of it, so like I've mentioned, for the rest of the tool, let me draw. It's inverted. Sorry, give me 1 sec. Okay, so for the rest of the tool, for example, okay, you can see here, there are the negative zones. The negative zones. So this is the positive, the 0 to 100. This is the normal Fibonacci retracement. Anything that is below 0, which is in a negative zone, are called Fibonacci expansion, which we will learn in the next session, not now. And then what we are learning today is Fibonacci extension, those that are above 100%. So once your levels are broken, like I've mentioned before, the V, remember, once you have broken the typical 100% for your Fibonacci retracement, whatever that is above are called extensions. Whatever that has broken your 0%, these are called expansions. So we usually use these 3 tools to help us better understand where our positions should be placed more accurately. That is called Fibonacci confluence, which we will learn in the next session as well. Any questions so far? So for Joelle, the name of this Fibonacci is called extension, but technically the whole chart is called Fibonacci retracement. Just that anything that is above is extension, anything that is below is expansion. Okay, now let us maybe move to, I hope that clarifies, yeah? Any more questions, feel free to post. Okay, you're welcome. Yeah, GBP. Oh, this is a tough one. Yeah, let's see. For Fibonacci retracement, usually we will look at the H1 and H4, not so much of the lower time frame, like 5 minutes, 15 minutes, because it will be too choppy, and we always look for significant swings. So for this chart, let's see. Okay, give me a minute to help you find an example. Okay, so like I've mentioned, right? Okay, maybe this might be a good example. Okay, Fibonacci extension don't always work 100%. So you can see here that this might not be a good setup because the swings are not very significant. You can try this. Always look for the V, yeah. It can be an inverted V as well, like I've mentioned. This one might be. It can be an inverted V. Okay, let's see. This is tricky. So let me see whether this is a clean setup. That's a good example. Like I said, right, you always have to use other indicators as well. It's not solely just the extension. It might not be that accurate. It might give you a false confidence of a trade. Okay. Very good example. Okay, Aisha, I will get to that later on. Maybe let me just find a good setup here as an example for you guys before we end the session on extension. I'm trying to give you guys a good example, a clear one. Okay. Always look for the V. Okay, maybe this is not a good example. I will give you guys another one. Maybe we can try USD. How about this? Okay, we are running a bit short of time, so I'm trying to give you another good example so that you can accurately use this tool yourself while you test it out at home. You can also do back testing if you would like to. Okay, this is quite good. Okay, let's try this. Okay, this is a good example. So like I've mentioned, always look for here. Okay, so at this point in time, I will take note since the reversal is quite strong here. So once it touches my 100% or surpasses it, it will have my attention to actually see whether I would want to take a trade at the 127 level. Okay, you can actually zoom out to daily or weekly to give you a double confirmation. Like I said, you can't use it on its own. Okay. See whether there's any key support or resistance level to support your trade. Okay. Okay, then you move forward. Oh, sorry, I should zoom into the 4 hours. Sorry, I was on a daily time frame. It's hard to see. Okay, so once, sorry, it's very, very messy. Give me one sec. Okay, here. Okay, so once it actually surpasses my, once it actually passes my 100 mark, I will then take note to see whether there are other tools like your support resistance or your retracement tools that coincides with this 127.2% level to make it a strong sell. So these are the two key levels that I will advise you to take note. So this one came in quite accurately at the 127.2. So you can see a very nice reversal. My usual will be short here or slightly above to give it some space. Sometimes it might exceed. My stop loss would be also slightly above, depending on your risk appetite. And then usually take profit is at 100. Or if you feel that the trend or the retracement might be strong, you can go slightly further to take your profit here. So Aisha, that means we take or place position only at extension levels. Yes, because anything that is between 0 to 100 is still considered a retracement. So only take note once it breaks this level. This should be a level that will alert you to take any positions if it reaches the 127. So maybe let me reiterate. For Fibonacci extension, it's actually a reversal tool. So we are looking to pick short positions, as you can see here. Hi, Isaac. You came in a bit late. So, okay, I'm coming towards the end of the session. Do let me know if you have any other further questions before I end the session. So two things that I want to leave with you guys is that you should always look for the V and always take note that it should pass the 100% level, retracement levels. So in the next session, please tune in. We will be talking a bit about expansion and confluence. Thank you, Kingsley. Thank you, guys. Joel.